Well, hello Internet, and welcome to my tutorial on exactly what is quantitative easing and an overview of the U.S. economic crisis. I'm going to be simplifying a lot of big words and going over a lot of statistics that very few people know about in this tutorial. And I'm doing this because I've received hundreds of emails asking me to do this. I'm going to go over exactly what quantitative easing is. Did it work? I'm going to show why the Federal Reserve chose to use quantitative easing to try and bring the United States out of its current economic crisis. I'm going to show you tons of charts on income taxes, wealth, net worth, etc. that I promise will not be boring. And for the most part, my main source here is the Federal Reserve Board's Federal Survey on Consumer Affairs and the U.S. Census, unless I tell you otherwise. So this is the situation we had after the financial collapse. The government wanted to avoid a run on the bank above all else. They wanted to stabilize the economy, avoid depression, and stimulate loans. The banks, on the other hand, wanted to make money and get rid of its toxic assets. The banks came to the Fed and they said, we can't lend money simply because we lost it. We just don't have any money. The Fed turned around and said, we'll give you as much money as you need to stabilize the economy, and we'll provide this money at nearly a 0% interest rate. The banks turned around and said, we're still worried about loaning money out because we have these toxic assets. What can you do about them? The Fed chose to buy $1.75 trillion of these toxic assets from the bank to further stimulate the economy and get the banks lending. The banks did something unexpected at this point. They decided to invest all that money that the Fed had actually given them at 0% into U.S. Treasuries and other U.S. bonds that paid roughly 2 to 3%. So what they are doing here is getting money for free, in essence, and then getting a guaranteed 2 to 3% return on said money. What a lot of people don't know about is that whenever the Fed wants to buy treasuries, they actually have to buy them from the banks. So the banks were making money here also. The banks were getting bonds and treasuries from the U.S. Treasury and then selling those treasuries to the Fed and then buying those treasuries back off of the Fed, collecting fees both ways. So what the Fed decided to do now was to go out and actually buy treasuries so that the banks could no longer buy those treasuries and bonds, because they did not like the way they were being manipulated. And then the banks made money again selling those treasuries by attaching fees to them to the Fed. The Fed then said to the banks, do you feel safe lending money now that we have provided all of this stimulus? In another turn, the banks decided to invest the money that the Fed provided to them not to stimulate the economy by providing loans to the general citizens and businesses in the United States, but instead to invest that money in unregulated high-frequency trading. By this point, the public was quite enraged by what was going on in this situation, and they demanded that the government do something to fix it. So the Fed approached the banks and they said, if you're going to continue doing what you're doing, we are going to force you to limit your executive pay. Shockingly again, because really the only role a corporation has is to act in the best interest of its shareholders, the banks said to the Fed, sure, we'll give you your money back. And since then, they've basically just pled for the United States government to not regulate them so they could continue to make money through high-frequency trading that is unregulated. So what exactly did the Fed, United States citizens, and the government get from quantitative easing? The Fed spent a total of $2.76 trillion buying toxic assets and U.S. bonds and treasuries. The financial institutions had their most profitable years ever. The stock market has been artificially inflated. Interest rates are the lowest they've ever been in history. However, the Fed did succeed in stopping a run on the bank, which is what they were concerned about the whole entire time. What a lot of people were unaware of, and this is what really forced the Fed to get into quantitative easing, is that real GDP, gross domestic product, in the United States historically has risen by 3% per year. However, after the Depression from 29 to 33, real GDP actually declined 34%, as you can see in the chart on the right. GDP remained below 10% until 1941, and during this period of time, the dollar lost 58% of its total value. Again, I'm talking about the Depression here. Deflation fell on an average of 6% year over year. That's the value of total goods fell 6% year over year during the Depression. Economists believe this dramatic fall had little to do with the stock market crash. In fact, economists believe it had more to do with the run on the banks and other policy mistakes of the government at that time. What happened during the Depression is citizens removed a large percentage of their savings from the banks because they were worried about a financial collapse. The banks, in fact, saw a 48% decline in total deposits, and on top of that, citizens decreased spending during the Depression by 58%. During the most recent collapse, the Fed thought its major goal was to do two things mainly: fight deflation and avoid a run on the banks. They succeeded with that. And how they chose to fight those two problems is to get as much cash as humanly possible into the system, and then encourage sound banks to lend that money to get the economy going again. You see, during the Depression, the Fed did nothing. Another thing that is pointed at as a major problem with the Depression was the Smoot-Hawley Act, which increased tariffs on goods coming into the United States. This is called protectionism. As the United States raised its tariffs, all of the other nations across the world also raised their tariffs, and they believe this caused a lot of problems with the United States and increased the overall length of the Depression. And this is also why the Fed and the government in general is very anti-raising tariffs. President Hoover is also blamed widely because of the Depression because he implemented price and wage fixing policies. He asked manufacturers across the country to not decrease wages, and also asked manufacturers to do whatever they could to keep prices stable. This is also why the Fed is anti-raising minimum wage and also anti-deflation. During the Depression, unions were also formed to protect workers. A lot of economists believe that these unions also hurt the economy. So in essence, the Fed did what it should have done. However, the banks had different motivations, and those motivations were not to help the United States. To give you a little perspective on exactly how much the Fed spent trying to quick start the economy, on the left side of the screen you can see this little bar right here represents $2.76 trillion that they pumped into the economy. This right here is the total net worth of the bottom 80% of citizens in the United States, which amounts to $4.54 trillion. So that means that the Fed pumped in over 60% of the total net worth of the bottom 80% into the economy. And here, by the way, is the total net worth of the next 19% and the net worth of the top 1% in the United States. So where exactly did the Fed go wrong? Well, they thought the money would make its way to the bottom 80%. Trickle-down economics all over again. Because the government did not regulate the shadow banking system, where you see high-frequency trading, which is in essence legal front-running, the banks invested all their money there, of course. And also, the corporations in the United States know that the bottom 80% don't have any money. So what they started to do was heavily invest overseas, also knowing that they would not be taxed on any profits that they made overseas. So the Fed overreached on fighting deflation, keeping wages low, allowing prices to rise, and in decreasing protectionism. And that was their major fault. So how do we fix it? It's not going to be quite that easy. I'm now going to give you a rundown of exactly the current state of the citizens in the United States and show you why fixing this problem isn't going to be particularly easy. You can see right here the average income of United States citizens. The top 1% earns $1.1 million on average. You can see how much of the total income base that is. Then the next 9% earns $164,000. And then you can see the bottom 90%, who earn an average income year over year of $31,244. And in fact, the bottom 80% earn only $19,000. So let's look closer at that 1%, and you can see that there is a very small fraction of the population that actually earns most of the income, as you can see right here in this pie chart. In fact, the top 0.001% of citizens in the United States have an average income of $27,342,000. So how exactly did we get here? Well, from 1950, which is considered to be the greatest point in history of the United States, the bottom 90% saw an average increase of 75% in income over those 30 years. However, from 1980 to 2008, the bottom 90% saw an average increase of only 1%, or $303. From 1950 to 1980, on the other hand, the 0.001% saw an increase of 80%, or $2,400,000. However, from 1980 to 2008, that same percentage saw an increase of 403%, or $21,900,000. Now let's look at the total net worth of all citizens in the United States. The top 1% have a total net worth, or a control, of over $27.7 trillion. The next 19% control $32.67 trillion, while the bottom 80% only control $4.54 trillion as a whole. That means that the bottom 80% only have control over 7.1% of the total net worth of the nation, meaning that the average household only has a total net worth, which is all assets minus liabilities, of $40 $48,669, while the average net worth of the top 1% of households is $23.77 million. So why exactly didn't the United States citizens notice while they were being robbed? Well, households were heavily motivated to get both parents into the workforce. Citizens thought the stock market would pay for retirement with its dramatic rise. I provide a link to a tutorial on the truth behind the stock market if you'd like to watch that. Credit cards were used to supplement lower income, and then home equity loans were used to pay off credit card debt. Most Americans are underwater with their mortgage, and a numerous number of them actually own over 300% of the actual value of their home. So let's have a little history of taxation here, just so I can cover everything in this one tutorial. Until 1802, sales tax on alcohol, tobacco, sugar, and corporate bonds were the only taxes in the United States. In 1802, they added taxes on gold, silverware, and jewelry. In 1817, they eliminated internal taxes, and the government actually ran completely on money that was earned through tariffs. In 1862, the income tax was created and changed multiple times until 1913. The rate started at 3% and increased based off of total income. In 1935, Franklin Roosevelt raised the tax rate to 91% for people making more than $4 million today, and that's in today's numbers. The belief was that the reason we should have a sliding scale on taxation was because the government at that time believed that those people earning higher incomes benefited more from government expenses in infrastructure, education, R&D, etc. than anyone else. In 1965, President Johnson lowered the highest tax rate down to 55.3%. In 1978, Jimmy Carter lowered capital gains rate from 48 to 28%. Then in 1982, Ronald Reagan dropped the rate from 55 to 27, and corporate taxes went from representing 33% of all federal taxes to 9%. Reagan then doubled the payroll taxes of citizens earning less than $40,000 per year, which dramatically hurts small and medium-sized business owners. And then we had two George Bushes, a Bill Clinton, and a Barack Obama, and this is where we are right now. The bottom 90% pays, on average, of 23.4% in taxes. That includes federal, state, local, sales tax, and capital gains, and all taxes inclusive. On the other hand, the bottom 0.01% pays an average of 16.9%. A lot of people get confused about this because they're supposed to be paying 35% just in federal. But you have to understand this group earns over 75% of their income off of capital gains, which are only taxed at 15%. Corporations pay an average of 12.6%. And whenever you hear about not taxing corporations for shipping jobs overseas, what they're actually talking about is the tax deferral system, which allows corporations to avoid taxes of any type as long as they keep those earnings outside of the United States. So here's an overall tax breakdown between 1950 and 2008. I don't have more reliable information in regards to today's numbers, and that's why I'm using 2008 numbers, because they're very reliable. You can see on the left side of your screen that corporate taxes in 1950 made up 25% of total revenue that the government brought in. And now in 2008, it's down to 5%. On top of that, you can see a dramatic drop in overall other taxes and a dramatic increase on payroll taxes. Again, this is supposed to go to Social Security, Medicare, unemployment, and so forth and so on. So you can see just from this simple chart exactly who is paying revenue to the United States government and who is not. So how have these changes in incomes affected the different groups? From 1980 until 2008, you saw the top 1% increase their overall income as a group by $673 billion or $597,000 per year per household, while the bottom 20% saw a total loss of $136 billion during this time period, or $5,623 per year per household. So can this be fixed? Well, what a lot of people don't realize is after the Great Depression, most of the loss of employment in the United States actually came through manufacturing, and not through all the other different sectors in the United States, as you can see in this chart here. And then if we look closer at non-farm jobs in the United States, we see that in 1950, 38% of all jobs in the United States were in the manufacturing field, while today it's down to 18%. And we've also seen a dramatic increase in overall service jobs, while total government jobs have pretty much remained flat, even though you hear the total opposite in the news every day. And transport, trade, and utility jobs have pretty much also remained flat. Well, now since we're in a situation where there is not a dramatic need for service jobs in the United States because people don't have any money, what we need to do instead is increase jobs in manufacturing, just like they did after the Great Depression. And this is a basic outline of exactly what needs to be done based off of what other nations have done recently in history to improve their economies, as well as what was done after the Great Depression. We need to increase infrastructure rebuilding, increase jobs in high-tech manufacturing, institute training and apprenticeships in manufacturing, create online free training by partnering with the blog community, for one thing. Citizens also need a fair arbitrator that is going to represent them in all businesses nationwide, or basically just do what Germany did in 1990. Germany is now the second largest exporter of goods in the world, and they turned their economy around basically by following exactly what the United States did after the Great Depression. We need to increase revenue by raising taxes on the wealthiest 5% because nobody else has any money. We need to relax burden on small and medium-sized business owners by decreasing payroll taxes. As per eliminating Social Security, Medicare, Medicaid, and so forth, this is the only safety net for the bottom 90%. If you don't remember, they only have a total net worth of $48,600, and it's hard to support yourself in the retirement years on such a small figure. For those people that say that taxation doesn't help people, it hurts nations, I list here the only 3 countries in the world that do not have an income tax. And the nation that has the highest overall tax rate, which is Denmark, also has the happiest people. Recently, the Canadian members of Parliament pointed out how income inequality destroys nations. They stated that societies with smaller income differences between rich and poor have fewer health and social problems such as teenage births, violence, mental illness, and drug abuse. So what nation, you may ask yourself, were they referring to? The United States ranks number 1 in regards to income inequality of all developed nations. And also, they rank number 1 in teenage births, imprisonment, homicides, infant mortality, drug abuse, and an inability to increase social status, which means that it is harder to increase your overall income or social status in the United States than it is in any other developed nation. And just to say that I pretty much covered everything, people are always asking who exactly owns all the United States debt. In fact, the United States, public and states, own over $9.74 trillion. Then you have the Social Security Fund, which has actually been looted. And then you have all other government debt held in the United States. And then all the countries that I have listed here on the right side of the screen. If you have any questions or comments, leave them in the comment section below. Otherwise, till next time.